Stefan, welcome to the show.
My pleasure. Great to be here.
Yeah, it's an absolute pleasure having you. I just want to start with like a very quick intro about you. You're now the managing general partner of Indico Capital. You've already backed five unicorns, and you've got about am I correct in 200 million AUM?
hmm
Yep.
hmm
And you've also lived in like eight countries and four continents, which is fascinating. Tell me about like how you got started with all of this and like what were you like at my age at 18 and how did you build that trajectory in life?
Right. Well, when I was 18, I had no idea. I mean, I decided I wanted to, go into engineering. So unlike you, I was not an entrepreneur. And I did my engineering degree, which was a 5-year degree at the time. And then I was lucky to get a job in a consulting company that worked all over the world. And so I lived in at least 8 countries, depends on how long you consider to be living, but I think there were 8 to 10 countries that I lived in, and in South America, in Africa, in Asia, based out of London. And then I did my MBA. I went to Harvard, and that's where I actually found out that I would like to be one day a professional investor. I had no idea about this profession, as a VC. But then I still did a lot of other things. I ended up coming back to Portugal, and being an advisor to the government, doing some consulting work. And then I ended up joining a huge utility as chief of staff to the CEO, with whom I learned quite a lot and met a lot of interesting people at board level. Then I got out, did a management buy-in, which is, I mean, I invested and became the CEO in an industrial company, something I knew nothing about. But I thought I was surrounded with the right people, which turned out to be wrong. I was not surrounded by the right people. So that was my second MBA. It cost me almost as much as the first one. And then eventually, I went back to banking and back to Africa, where I had lived before. Founded a bank there on behalf of a big Portuguese bank. And a few years later, when we sold that bank, I came back to Portugal. And so I've been on and off from Portugal for many times. And essentially, I started heading up venture capital and co-heading private equity. And so essentially, I was throughout my career an engineer. And then I did an MBA. I was a consultant, an investment banker, a CEO, an entrepreneur, and now an investor. In 2017, I ended up leaving my corporate job as a banker that was really doing private equity and VC and setting up my own fund. And here I am. Since 2017, we have founded Indico, launched 5 funds, looked at 4,000 investment deals, ended up investing in 48. So that's about 1% or so of the opportunities we saw. And in the last decade, 5 unicorns and a bit over 3 billion raised by our companies. So it's 50 years in a few seconds.
That's absolutely amazing, and there's a lot to unpack there. I want to talk to you about location though first, because you've got a lot of experience moving around. You've seen Africa, you've seen Asia, you've seen South America. I'm sure you've seen North America as well. You've seen Europe. If you're a young founder today and you're looking ahead at your life and you're thinking, I want to build a unicorn, where should you strategically base yourself to be able to reach that goal? Do you still think a place like a continent like Europe and specifically Lisbon or some of these other major European cities, they're good places for a young founder to be, or what do you think?
Look, I mean, I think that obviously it depends on the market and the product, but ultimately it's not so important where you are physically, because nowadays we can all be remote and you can get talent from all over the world. But it is also important that people get together now and again. So I would pick a place in terms of sort of a work base, somewhere where people are comfortable and they like to live. And even if a big part of the team is remote, you have to meet somewhere nice. And I think Lisbon is a great candidate, of course. That's why we have so many people that have moved here in the last decade. But from a market perspective, I still think that addressing the U.S. market is absolutely crucial from a Western point of view. I mean, of course, if you are in Asia, maybe it's not the U.S. If you're in Africa, well, it depends. But we always tell our founders that they should definitely try to target the US market, regardless of whether they're based in Lisbon or in London or in Munich or wherever they are, because it's the largest market in the world. It's the most competitive market in the world. And if you do well, you're going to raise a lot of capital. If you do well, you're going to sell to a lot of people, to a lot of corporates. And these customers in the US, they have more firepower, they have more willingness to pay for your solution if it's a good one, and they're easier to conquer in the sense that they're more willing to test different solutions and innovative software and solutions. So definitely, I think that it's still true that it's very important to address the US market, but that doesn't mean that you have to be based there. But you need to access talent from the US as well, particularly sales and marketing talent.
Absolutely. And then in terms of, I think a lot of founders, they struggle when it comes to being able to approach investors the right way. Now, you sit in the investor seat, although you've sat in many other seats before, and I'm sure you get hundreds of emails, thousands of emails of founders trying to pitch you and have a coffee with you, get a piece of your time. How should, if you're a founder today and you're building a startup, your early stage, and you're looking to raise some seed or your Series A or whatever that the stage may be, how should a founder approach an investor? What's the right way to do it? And then what's the wrong way to do it?
Look, it is true. We get dozens of emails. I get personally dozens of emails, not hundreds, but dozens of emails pitching every day. I think the first thing is you need to know, what's the strategy of the fund that you're trying to reach. I get a lot of emails, for example, with deals from all over the world, and if you go to our website, it basically says that we invest primarily in Southern European opportunities. They could be American, but they need to be based out of South Europe or have some sort of connection. So there's no point on people from, say, Mongolia or Finland sending me opportunities, because I'm just going to delete them, even if it's the best opportunity in the world, or if it's just a pure American great opportunity. I'm not going to look at it because I cannot. So it's very important that when you shoot an email to an investor, that you actually understand what they're looking for. And if you just go to the website or just ask ChatGPT, it will tell you what we do. And so I think that's the base line. But also it assumes that you are going to be proactive and that you are actually going to send emails or LinkedIn's or some other form of reaching out, because there's also a lot of people that say, oh, I don't know how to reach out. Well, there's lots of social media platforms and we're all there. And so it's not difficult to find people. Now, the second thing is, ideally, you should do it through someone that already knows us. It doesn't have to be, but I think most VCs prefer to be introduced by someone that they trust or that they know, rather than answering a cold email. So then I think that varies a lot from person to person, whether they are. I'm very quick on answering emails generally, but some people take a little bit longer, and some people just don't answer emails from people that they don't know. But in general, a warm introduction is always obviously preferable. But ultimately, what is more important is that when you communicate, you say specifically, why is your solution much better than anything else out there in the world? Why is your market potential huge? And if you already have clients and traction, talk about it and talk about the team as well. This could all be done in one paragraph or three or four sentences. But before people actually open up the PowerPoint or PDF that you send over, if you just put it on the header and on the main text of an email, just the general idea and why you're so different from everything else, that helps.
Amazing. So, just to recap really quick, first is what a lot of founders don't do is they don't necessarily do their homework. They don't research the
Yeah,
fund that they're approaching. So, I could be an American company, approach your fund, but if you're only focused on Southern Europe, I'm wasting both of our times by even emailing you. Second is try to get a warm intro if you can, because there's always going to be more trust. And then third is be very concise and mention all the the very basic and essential things about your idea. So what your idea is, what problem you're solving, your market size, what makes you different, bit of your traction. Be very concise, be very clear, and then send that if you can't get a warm intro. Am I correct in that?
that's a great summary. It almost looks like it's been but done by AI. Yeah,
Awesome. And I
very
want to
good,
talk
very good summary.
Awesome. I've got a chat GPT in my head. I think, it just works automatically.
Better than ChatGPT.
Absolutely. And then I want to talk about bootstrapping versus fundraising because it's always a challenge to think about if you should bootstrap immediately or at what stage, what point of a company you should try and start approaching investors. I've talked to a lot of people who say, "Oh, it's a waste of time. You should just focus on getting revenue." What do you think? When do you think it is the right time to start fundraising and approaching investors?
Well, that depends because obviously if you're able to start a business and it's sustainable from day one, which means you're making money, you might want to delay the entry of external investors until the point that you think that you've nailed it. You're paying your bills, and now you want to scale faster. You just need capital to scale. But many startups, namely, software startups and just tech, basically that's not the case. Basically, you need money to sort of build or fine tune your product. You need money to reach out to more customers very quickly. Although, of course, if your product is really, really good, you probably don't need so much money to sell because it sells by itself. But it is difficult to do things without money in tech nowadays. Although the sort of barrier to entry of creating a company is way, way lower than 10 or 20 years ago because you don't need infrastructure, you don't need a lot of people. Everything is kind of a variable cost. But nevertheless, capital is important to sort of win the race to be the number one. But the purpose of raising capital is not just to raise capital at a higher valuation so that you believe you're a paper millionaire. It's really to give you the resources to actually get things done with the best team possible in the fastest and shortest time frame possible. That's why you need money, not to sort of be self-indulging in some sort of term sheet that makes you think that you are the new tech millionaire. It's really not about that. It's really about sort of creating a solution, solving problems, and just doing well for yourself, but also for society.
In your answer, you said something very interesting. You said if you're a software company, you need the resources that venture capital gives you for the product and then the distribution. Now, distribution part, if your product truly solves a need, usually you don't need to pour money into paid marketing. You can usually grow very solid, in a very solid
Organically.
way, just through organic. And then the second is product. Now, I saw an analysis, and I want to get your take on this. It was a gentleman who was writing a Twitter post, and he had worked in the private equity industry, and he was talking about how there are a lot of companies, a lot of software companies that raised very they raised a lot of money because they need a lot of engineering talent to build their product, which meant sky high valuations. But then now with AI, because the cost of labor is going down, because now you can have literally AI employees building your product, and you don't need to hire as many engineers. Now they're struggling with liquidity because private equity firms are staying away from them because they've got such high valuations without much justification because they don't need that labor anymore. How do you think that impacts venture capital in the future? Do you think are we going to see check sizes get smaller because companies generally need smaller checks because they don't need as many engineers and they don't need to go out and hire 1,000 engineers? How do you think that's going to change? How do you think those dynamics are going to change in the future?
So I think there's two things inside what you just said. One is that this question about valuations is really tricky because I've seen many founders try to maximize valuation and particularly take advantage when the market is hot and when they can sort of squeeze a much higher valuation out of the investors than what it should be. And then quite often, sooner or later, it fires back. It fires back, particularly if the performance is not there. And quite frankly, normally the performance is not there. Not as good as people thought originally in 90% of the cases. And particularly if there's a downturn, like there has been in the last few years, you end up having lots of founders that raised at very high valuations. And then it's extremely difficult for them to accept, and sometimes their investors to accept much lower valuations because they're going to have to mark down the value of the portfolio. And for the founders also, it's extra dilution and so on. And it's just, expectations that were not met. And so what we always recommend is that people, raise capital from the funds that they think can help them to sort of develop better, rather than choosing on the best valuation. And there's some people that understand this, and there's some people that really cannot see past. The only thing they see is terms and conditions, and they're just pure negotiators, and it is what it is. And sometimes it's okay, but quite often things end up going wrong in that scenario. So that's number one. Now, regarding what you said about ticket sizes in deals, I think it depends, because also if you think about it, if you don't spend money on engineers, you're going to spend it on AI engineers, on AI processing, and that's quite expensive as well, and getting more expensive. So it is not clear yet whether the money that you need to actually build a startup is going to be lower. I suspect not, because the market will tend to sort of equilibrate itself, and you substitute one type of cost for another type of cost, or you just go faster. The other reason why this is unlikely to happen is that the money is there, and so there's a lot of money in the market regardless of the cycle. And when there is capital, the funds have capital, they will have a tendency to deploy it. So they'll have a tendency to, one way or another, put it to use. Now, whether it's good use or bad use, that remains to be seen, and it depends on the investors and on a case-by-case basis. But I don't think the trend is for lowering average tickets. In fact, the trend is to increase the average ticket, but maybe less tickets and less companies get invested. That's at least what happened in the last few years. But venture capital is a cyclical asset class. It goes up and down, so it's prone to bubbles, boom and bust, and so we're going to see these cycles play out constantly during every decade.
You mentioned something very interesting about the fundraising process, and that's a lot of founders, when they get the term sheets, all they're excited about is the fact that someone wants to give them money for their company. So, they forget the fact that it kind of like what happened with Travis Kalanick with Benchmark and Bill Gurley. If you've picked the wrong investors, you might get fired. You might get a lot of bad things that happen to you. I want to ask you about how a founder can actually discern whether or not an investor or a fund is right for them? How do you know that a fund is going to have your best interests in mind? And how do you know that they're going to be right for you and it's not going to end up disastrous?
Yeah, I think there's two things. I mean, having the best interest in mind has to do quite often with the way you set up the deal. So when you negotiate, any negotiation really has to be good for both parties, whatever negotiation you are doing. And so when one party takes advantage of the other party, and when the terms are not fair and they're not standard, and they're sort of skewed towards the benefit of one side, that will come back to bite you. So again, we go back to the questions of valuation and other terms. If the market is too hot, probably the founders shouldn't be taking advantage of the funds. And if the market is too cool, the funds shouldn't really be taking advantage of the founders. And so you need to find that correct balance and try to identify the term sheets that sort of translate that sort of fairness and regular market valuations and standard terms. Now, more important than that, I think, again, is how do you choose the right VC? And I think it's a mix of reputation. Reputation is demonstrated competence in helping founders achieve different levels of excellence and of development of their companies. And so that's why you have great brands all over the world that have demonstrated supposedly over decades that they do a good job. So brand is very important, way more important than valuation for sure. And then specifically, you might have partners or specific knowledge within those funds or within those partners that actually can help you specifically in your issues. So again, it's important to look at it at an investor has a not only a co-investor in your company, but has a shareholder and someone that is going to be by your side and someone you want to be with in the long term, because it's going to be a few years, eventually up to a decade together, and you don't want that to be a difficult relationship. So I think when the problem I see is when founders think, oh, we're just going to get money because we do the whole thing. We don't really need them. And so they underappreciate the value that very experienced people can bring to the table, particularly if you bring it out of them, um, rather than just seeing it as, oh, this is just money. Because it's actually not just money. The funds are representing other people, the savings of people, sometimes, teachers and firemen and people like that that put money into funds so that we choose the company. So you're actually just a conduit of people, regular people that want to sort of invest in your company. So we need to respect that capital. We need to respect the savings of these people that are going into your company. So it's really not the VC's money. It's also the VC's money, but they're representing third parties and third parties that need to be respected as well. So it's this mix of being having the right attitude, has fellow shareholders and partners in a situation, and fellow board members, and you're there to defend the interests. We're all there to defend the interests of the company.
Absolutely. I think some that's not talked about as much is the post fundraising process. You mentioned building that relationship with, the fund managers at your venture capital firm that's invested in your company, and making sure that you take advantage of their expertise, their knowledge, their experience, because often they can have a lot of valuable insights to offer you. I want to talk about how a founder can go about doing that. Let's say you've signed a term sheet. You've said, you know what,
Hmm.
I'll take the money. The money's at the bank. Everyone's happy. They're shaking hands. Now it's time to build. How do you
Yeah.
keep that relationship? How do you build that trust over years and actually, like you said, take the insights out of the, find ways to, you know, extract the insight. How do you do that?
Right. I think it actually starts before you take the money. So a part of the due diligence of the VCs is also understanding how the founders behave during the negotiations. It's extremely important. It's kind of easy to understand whether the product is much better than anything else out there. It's kind of easy to understand if it's a big market or not, and if the business model makes sense from a logical and data point sort of perspective. But it's super difficult to understand if these are the right people. And one of the things VCs do is during the negotiation phase, during the time that they're asking questions and trying to understand whether they should invest, they're really evaluating the founders. They're really trying to understand, who's this person in front of me? Can I trust them? Can I entrust them with the capital that I represent? Can they be ambitious enough, but at the same time humble enough to work with me, day in, day out? And will they listen? Can we have a trustworthy relationship, or are they just going to take the money and sort of never pick up the phone again? And so I think that's where it starts. And then of course, once the deal is done, if you have a board, then you should obviously sit with the lead investor or the chair or the other board members and set, the stage of, how are we going to run these boards, or if it's not a board, how are we going to meet regularly, every month, every quarter, something, and see and share freely. These are my issues. These are the things I need to work on. Where can you help me? And if there's a good relationship, I'm sure the vast majority of VCs can add value.
You mentioned venture capitalists really pay attention to how a founder behaves during the negotiation process and the way they act. What are specific things you're looking for that makes a founder trustworthy versus
Mm-hmm.
convinces you that maybe they're not going to pick up the phone after receiving the money?
Right. I think the two things that we're kind of not looking for is people that lie. So one thing is, this sort of idea of fake it till you make it has limits, because it is very easy to be caught up in a lie, or in a sort of a white lie or a real lie, where you're telling something that is really not there, or the numbers, if the numbers are not real and you're portraying to be something that you're not. These are sort of, it's the end, right? If you stop trusting the other person because they're lying, that's a really no go. The second thing is on the negotiation, right? If you think that the person it's okay to be ambitious, but it's not okay to be selfish or totally, I take everything and you keep nothing. That kind of attitude for us, it's a big turn off, right? So the opposite of that is being transparent, building a relationship, being, sharing your concerns and being very truthful about the upside and where we think we can sort of, you know, reach together.
Awesome, Stefan. That's it for all the questions I've got. Is there anything that you'd like to add or specifically talk about?
No, I'm good. I'm very happy that I can share a little bit, and I hope it's inspiring. And if you have a global Southern Europe opportunity, send them our way.
Awesome.